We all want financial freedom and the ability to retire with enough balance that without withdrawing pays all our monthly expenses, right? But is $10,000 a good starting point for that? The short answer is yes, but you need to know what you're investing in. The easiest way to achieve this is by investing in ETFs. The problem is not every ETF will get you to that point. The goal is to live comfortably in retirement, let's say with over $5,000 per month in income. To reach that goal, you need the best dividend-focused ETFs. In this video, I'm going to show you and John just that. First, I'll show you how much time you'd need with simple S&P 500 ETFs to reach a $5,500 monthly income goal. Then I'll show you a portfolio of 3 of the best dividend-focused ETFs that will help you reach the same goal in half the time. But first, let's talk about the S&P 500 ETFs for a second. If you're looking to grow your money, they're definitely a solid option. After all, they track the 500 biggest and most stable companies in the US. But here's the thing, while these ETFs are great for growth, they're not exactly the best when it comes to paying dividends. You might be thinking, but wait a minute, the S&P 500 is full of big companies. They must be paying pretty solid dividends, right? Well, not exactly. Most S&P 500 ETFs have a dividend yield of under 2% with a 6% growth rate and an average annual share price increase of 10%. That dividend yield is kinda on the lower side when compared to other ETFs that are focused more on dividends. So what does this mean for our goal of earning around $5,500 a month in dividends? Well, if you were to invest $10,000 in an S&P 500 ETF today, you'd be looking at about $200 in dividend income for the first year. That works out to around $16 a month. Fast forward 30 years, and you'd be getting around $3,800 per year, which is about $300 a month. To hit that $5,500 per month goal, you'd be looking at waiting 56 years. So why does it take so long? Well, S&P 500 ETFs are more about growth than generating huge dividend payouts. The companies in the S&P 500 usually reinvest their profits back into their businesses rather than paying them out to shareholders as dividends. So while your investment will definitely grow, those dividend checks are going to be pretty small if you're hoping to hit big income targets anytime soon. Now that we've seen why S&P 500 ETFs might not get us to that $5,500 per month dividend target anytime soon, let's talk about how to pick the right stocks and ETFs to help you reach your income goals. First up, let's talk about dividend yield. This is important because it shows how much income you can expect from an investment based on its price. A higher yield means more income up front, but here's the catch. You want a sustainable yield. If the yield is too high, it might mean the ETF or company is paying out too much, which could be risky in the long run. Next, we've got the dividend growth rate. This is how much the dividend increases year after year. When you're investing in ETFs, you want to see strong growth in dividends because it means your income will keep going up over time, even if the starting yield is a little lower. Then there's the payout ratio, which shows how much of a company's earnings are paid out as dividends. A lower payout ratio is usually better here because it means the company has room to grow and can keep paying dividends even during rough times. The max you can go is around 60%. Lastly, don't forget about sector diversification. By investing in ETFs that spread your money across different sectors, you reduce the risk of being too dependent on one industry. These are the key factors that help us create a portfolio with reliable growing income streams, not just the highest yields. And based on all of this, we've picked 3 ETFs that are solid choices for your goals. Number 1 is the Schwab US Dividend Equity ETF with the ticker symbol SCHD. It's one of the top dividend ETFs out there. If you're looking for something that combines stability with solid dividend payouts, SCHD is a strong contender. Over the years, it's proven to be a steady performer, delivering reliable returns without being too flashy. It might not always be the highest flyer in the market, but that's exactly why it's perfect for long-term investors who want consistent growth and dividend income. Looking at the performance of SCHD, it shows a 1-year return of 7.94%. which, while not huge, is staying close to par with the S&P 500. It's great for a dividend-focused ETF. But what really sets SCHD apart is its dividend growth. With a 10-year dividend growth rate of 11.04%, SCHD is known for increasing its payouts year after year. In fact, it's been increasing dividends for 13 consecutive years. What else makes SCHD stand out? Well, for starters, this ETF focuses on US-based companies with a strong history of paying dividends. What's great about this approach is that SCHD isn't chasing after risky, high-yield stocks. It's investing in well-established companies that have shown they can weather both good and bad times. Plus, SCHD comes with an expense ratio of just 0.06%, which is extremely low, meaning more of your money is working for you and not going to fees. Another great thing about SCHD is its sector allocation. The ETF is well diversified across multiple industries, with healthcare making up a large sector at 18.54%. Next up is financials at 16.53%, followed by consumer defensive at 15.4%. With these sectors, SCHD gives you exposure to industries that tend to perform well even in volatile market conditions. It's not overly reliant on any single sector, which helps manage risk. And it even includes a decent chunk of energy stocks at 11.54%, giving you a taste of growth without making the portfolio too risky. When you look at the top holdings in SCHD, you'll see some big names that have proven their dividend reliability. Companies like AbbVie with 5%, Amgen at 4.79%, and Coca-Cola at 4.67%, all among the top players. These are companies you've likely heard of, and that's for a good reason. They're stable dividend payers. Having a solid chunk of your investment tied up in reliable companies like these is a big part of what makes SCHD such a great long-term choice for dividend investors. Currently, SCHD offers a dividend yield of 3.5%, which is higher than some other growth-focused ETFs. But it's the dividend growth that really shines here. With an 11.04% dividend growth rate over the past decade, SCHD doesn't just offer a solid payout today, it offers growth over time, which is the key to building real wealth. And with an annual share price appreciation of 7.71% over the next 20, 30, or 40 years, those dividends are going to compound and add up significantly. But there are always risks involved. SCHD's performance is tied to the health of the U.S. economy, so if things take a downturn, so might the ETF. But because it focuses on high-quality, dividend-paying companies, it's less volatile than other, riskier growth ETFs. You won't see the crazy highs and lows, but you'll get a steady ride with growth and dividends. Next up, I'll show you and John two more dividend-focused ETFs, and in the end, I'll show you a portfolio of these ETFs that has the potential to turn your one-time $10,000 investment into a $500,000 portfolio that pays over $5,000 in monthly dividend income. Now let's look at another solid option for the portfolio, iShares Core Dividend Growth ETF with the ticker symbol DGRO. This ETF, like SCHD, also focuses on companies that are known for their ability to grow dividends over time, which makes it a great fit for portfolios. One of the standout features of DGRO is its incredible dividend growth rate. Standing at an 18.31% annual increase, DGRO is growing its payouts much faster than many other dividend ETFs. And if you're in it for the long haul, that's a big deal. It means your income stream is only going to get bigger over time. Add to that its solid 2.22% dividend yield, and you're starting off with a nice, steady flow of income. As it keeps growing, you can expect those dividends to rise along with it. On top of that, DGRO offers a healthy 8.73% average annual share distribution, so you're seeing both growth and income coming from multiple directions. In fact, over the 10-year period, it has increased its value by 129.56%. Now, let's take a look at DGRO's sector breakdown. Unlike SCHD, DGRO has a higher exposure to technology stocks, with 18.25% of its portfolio dedicated to this sector. This gives DGRO a bit more growth potential, especially if the technology sector continues to perform well in the years ahead. The top two are more or less similar to SCHD, with financials at 19.3%, healthcare at 18.59%, and technology at 18.25%, making sure that the ETF is well diversified across industries that tend to have strong, stable, dividend-paying capabilities. When we look at DGRO's top 10 holdings, they're some of the biggest names in the world, and they make up a good portion of the fund. The top holdings include companies like Johnson & Johnson with 3.33%, AbbVie at 3.3%, and Apple with 2.85%. In terms of dividend sustainability, DGRO has a good payout ratio of around 50%, which means companies in the fund are reinvesting enough of their profits to continue growing while still paying out solid dividends. This is one of the reasons why DGRO's dividends have grown at such a rapid pace. Now, before showing you the portfolio that has the potential to reach the goal in half the time of any S&P 500 ETF, at number 3, we have iShares MSCI Europe Financials ETF with the ticker symbol EUFN. The previous two ETFs, SCHD and DGRO, focus on the US market. Meanwhile, EUFN gives you exposure to the European financial sector. And if you've been paying attention, you'll know that global diversification is a key strategy for managing risk and maximizing growth over the long term. EUFN focuses on banks and financial companies across Europe, giving you a completely different set of opportunities than the US-focused ETFs. One of the most appealing things about EUFN is its 4.44% dividend yield, which really stands out when compared to ETFs like SCHD and DGRO. If you're looking for strong dividend income, this one should definitely catch your eye. While it might not be the highest yield out there, it's still pretty solid, especially when you consider that the financial sector has a strong history of steady payouts. Plus, with a 5.41% dividend growth rate, EUFN is set to keep increasing those dividends over time, which adds even more value. But this high yield does come with a slight drawback, which is it can't grow its share price at a much faster pace. It hovers at around a 2.33% average annual share price growth. What makes EUFN stand out is its heavy focus on financial institutions, including some of the biggest and most important banks in Europe. Unlike SCHD, which spreads its investments across multiple sectors, EUFN is 97.2% focused on the financial sector. So while it's not broadly diversified itself, this can add decent diversification to your portfolio, especially if most of your other investments are in US companies. However, its exposure to tech and industrials is small, so while EUFN is great for financial growth, its performance is mostly tied to the European financial sector. So let's take a look at EUFN's top holdings, which highlight its focus. The ETF's top 10 holdings make up 41.06% of the portfolio, and they include some of Europe's most well-known financial institutions like HSBC, Allianz, and UBS, all of which have a history of being stable dividend payers. One of the things to keep in mind when investing in EUFN is that it's an international ETF. This means you're exposed not just to the performance of individual companies, but to foreign currency risk, geopolitical instability, and potential economic slowdowns in Europe. However, this also opens the door to opportunities that US-focused funds might miss out on. Now it's time to build your portfolio and see how much it can return over time. But before we look into the returns, we need to calculate the portfolio metrics. Let me show you how. We know SCHD has a current dividend yield of 3.5%, a dividend growth rate of 11.04%, and an average annual share price appreciation of 7.71%. DGRO has a dividend yield of 2.22%, a dividend growth rate of 18.31%, and an average annual share price appreciation of 8.73%. And EUFN has a dividend yield of 4.44%, a dividend growth rate of 5.41%, and an average annual share price appreciation of 2.33%. To calculate the portfolio average current dividend yield of these three ETFs, we simply add up their yields and divide by 3. For example, let's say we're looking at SCHD with a yield of 3.5%, DGRO with a yield of 2.22%, and EUFN with a yield of 4.44%. So the calculation would be the total of 3.5% plus 2.22% plus 4.44%, all divided by 3, which gives us an average dividend yield of 3.39%. You can apply the same method of averaging to calculate the dividend growth and share price appreciation for the portfolio. So if you combine these ETFs, you'll have a portfolio with a current dividend yield of 3.39% and a strong average dividend growth rate of 11.59%, along with an average share price appreciation of 6.26%. Based on these metrics, let's break it down and see how $10,000 invested in this ETF-based portfolio grows through the decades. In the first year, your investment would grow to about $10,964. That's a $964 gain from a combination of capital appreciation and dividends. By the end of 10 years, your $10,000 would be worth around $27,340, meaning you've more than doubled your investment. And this is without adding anything extra. You've simply reinvested dividends. After 20 years, your investment would grow to $97,189. That's when the compounding effect kicks in, especially when you have solid dividend growth rates like those from SCHD and DGRO. After 30 years, your original $10,000 has the potential to reach $529,032. Around the same time, this portfolio will be paying around $66,466 in annual dividend income, or about $5,539 in monthly dividend income. In total, this portfolio will add $519,032, of which $181,236 comes from capital appreciation, while $337,795 comes from reinvested dividends. Okay, so let's compare how this portfolio stacks up against an S&P 500 ETF in reaching the $5,500 per month dividend goal. If you invested in an S&P 500 ETF, as we saw earlier, it would take 56 years to hit that $5,500 per month goal, assuming average returns with a dividend yield of around 2%. While the S&P 500 is known for its strong growth, its relatively low yield means you'd be waiting decades before reaching that level of monthly income. In contrast, our portfolio of SCHD, DGRO, and EUFN has a higher yield of 3.72% and a solid growth rate. This means it can reach the same $5,500 per month goal in half the time thanks to the stronger dividends and growth of these ETFs. Want to know how to create a portfolio of the best dividend aristocrats combined with ETFs and REITs that pays over $6,000 in monthly dividend income with only a $20 a week investment? Click the video on the screen to find out how.